And I'm going to turn things over to Liz Lowe. She is our quality assurance manager, and she'll be talking about internal controls. Liz has a degree in accounting and has more than 20 years of governmental auditing experience. She's worked as a financial auditor and auditor in charge over local government audits in Central Kentucky, and has assisted in the completion of other audits such as the state's annual comprehensive financial report and the statewide single audit of Kentucky. She's also served on special examinations and on developing and revising audits programs. As I mentioned, she's currently the quality assurance manager and focuses on ensuring the auditors at the APA comply with auditing standards, as well as on internal and external trainings. Liz, do you want to take over?
All right, Jonathan, can you see my slides?
I can, and I can hear you too.
Okay, so good afternoon. I love having this post-lunch slot. It's the time of day, you know, when people have had lunch and they're getting a little tired, and maybe you need an exciting topic post-lunch, right? So internal controls, not terribly exciting, but as far as I'm concerned, you know, critically important. So I'm going to try to make it interesting for you. But if you find yourself nodding off or something, maybe stand up, do some jumping jacks. Nobody will judge you, even though we can see you. Nobody will judge if you decide to move around or dance or something behind the scenes. So what I have hope that I have done here is been able to find a way to approach internal controls from a perspective of a person who might be new to hearing about internal controls. Typically, when we present internal controls to an audience, it's to a group of officials who've been in place for a while, and so they're looking to shore up their internal control structure or find ways to improve it, or maybe they just are interested in getting rid of an audit comment that has told them that they are lacking in some internal controls. So internal controls is one of those topics that you could go all day on. And in fact, you know, there are plenty of multi-day seminars you could get nationally from national speakers that go into great depth and great detail about what internal controls are. So what I've tried to do here is get it down to an hour. So hopefully you'll bear with me. Hopefully you'll learn something today. And if it piques your interest, I'm going to give you some resources at the end that will tell you where to go if you want to find out even more information. So this slide tells a little bit about me and gives a little bit about my background and my interest in this subject. Every auditor will tell you in their first few years of auditing that they hate internal controls. They're hard to understand, they're hard to find, they're hard to identify sometimes. The auditees don't always know what we're talking about. But over time, with the audit work, you come to really appreciate how important internal controls are and how helpful they are in our audit structure. So over my years of auditing and working on all different kinds of engagements and investigations and those sorts of things, developing training and writing audit programs, I've learned a lot about internal controls. It's really had a big impact on my life. And even, you know, every now and then my husband will say, can you just turn off audit mode, please? Because, you know, it sort of bleeds into my regular life, talking about controls and about auditing. So hopefully I have come to you with enough experience to be able to understand what I'm talking about. And you can judge by the end of this whether or not I have. I like to start every training that I do with some objectives because it lets me know where to stay on topic, and it lets you know where we're going today. So the questions that I hope that I can answer for you today are: what are internal controls, why you need them, what happens if you don't feel that you have the budget for them, and then what happens if you don't have them at all, or if there's a big hole in your internal control system, you know, what could happen if that's the case. So what are internal controls? They're the measures collectively that you put in place that help safeguard all your assets and help prevent and detect errors and fraud in your financial system. So they can be as simple and straightforward as like locks on the doors, passwords on the computers, reviews, cross-checking from employees, or they can be really complex and involve like multi-layers of access control or analytical procedures or data mining that you might do behind the scenes. Those last few are typically seen in larger organizations or more complex organizations. So today with most county governments in Kentucky being on the smaller scale, we're going to focus on the controls that are going to be most helpful for a smaller governmental entity. So a good system of internal controls is all of these defense measures collectively working together to protect your office from fraud and errors. These fraud and errors can impact the integrity of your office and the accuracy of your financial statement, which is the focus of your audit, if you remember from Farah's presentation earlier. So what's your responsibility? You may not have had time to read an audit report yet. Once you do read an audit report, or once you get an engagement letter for your very first audit, once you get a representation letter for your audit that you have to sign, you're going to see us repeat this management responsibilities section over and over. It's going to be repeated in all these places. And that's because in the big picture, the governmental accounting standards, this is your accounting standards, not our auditing standards. Governmental accounting standards require management, that's you, to take responsibility for certain things. And one of those big, giant responsibilities is for the internal control system. So you're responsible for designing, implementing, and maintaining an internal control system that helps prevent material misstatement of your financial statements. So those words in red are really key here. Chances are, unless you're starting from scratch, an internal control system has already been designed and it's already been implemented where you're going to be working. May or may not be in really good shape. We'll talk about later how you can find out whether or not that's the case. But even so, if it's been designed and it's already been implemented, then you still have the responsibility for maintaining it. We can't just fix it and forget it, using that common phrase. We have to keep maintaining and checking in with it and make sure that it is still working. So the second part of the sentence talks about whether due to fraud, whether due to error, fraudulent financial reporting, etc. What this means is if your financial statements, that's the document that our audit is giving an opinion on. If your financial statements are misstated, it doesn't matter why. It doesn't matter if it was a fraud. It doesn't matter if it was an error or some sort of fraudulent financial reporting. If they're misstated, that's an issue. And, so that's one thing that says that management has failed in their responsibility to put an internal control system in place. The standards don't care why it happened. So it's important to make sure that you are paying attention to internal controls, because you can't say, well, that was just a mistake. We made a big mistake. Oops, our bad. You don't get to say that. You have to take responsibility for putting the controls in place that will either prevent that error or fraud from happening or detect it if it does happen and then correct it in your financial statement. We can't let that go uncorrected. All right, we're going to go into those three words that were in red on the previous slide a little bit deeper. We're going to look a little closer at those. So you have to design the internal control system to prevent the errors and fraud from happening and then being undetected. Beyond having policies and procedures, beyond having a policy procedure manual, beyond having notifications to staff. We can't just tell staff, hey, we expect there to not be any errors. You have to implement the controls and then make sure that everyone understands that the control system needs to be followed, that they're not to circumvent controls just because circumventing is easier or it makes their life, a little bit better to go around a control. They need to understand that the controls are there for a reason. So that's the design and then the implementing to make sure that they're still working. And then maintaining means to keep reassessing. When things change is when risk increases particularly. So when things are just bumping along day to day, you might check in every now and then like, hey, are we still following all of our procedures? Everybody's doing what they're supposed to do. Nobody's circumventing. Good. This is good. When change happens, like say a global pandemic happens, and then our work environment changes drastically. I know a lot of you had to maybe reduce your staff, send some people home, have people work in different locations. So that caused some reevaluating and some changing up of duties, responsibilities, and access. We started to worry, and the audit community as a whole started to worry when we saw this happening, because we know that when change happens, risk increases. And so because all of this was happening so fast, you might not have time to think about risk in the heat of the moment. You know, you're suddenly having to change things. You might not think, okay, how risky is this? That I'm sending everyone home and I'm putting all of these responsibilities on one person. Am I also now increasing the risk that that one person could commit a serious error that won't go noticed, or commit a serious fraud that won't be found or noticed? We don't always have time to think about that, but that's really important. So just keep in mind, I know things have settled down from the pandemic now, and probably everyone's back to full staff, and hopefully have re-implemented controls that may have been moved around during the pandemic. Put those controls back in place. If you haven't, or if your office hasn't, and you get in there and you say, okay, I'm new, what did you all do during the pandemic? And then what did you all do to fix it, you know, to put everything back to normal? You know, make sure that happened. You know, just make sure that when change happens, be aware that when change happens is when risk increases, okay? And that you can't just think in terms of ease. We're going to make things easier, so here's what we're going to do. You have to take that one step further and think, all right, now I'm making things better. I'm making things better for the public and for my employees, but what am I doing to my internal control system? You know, and what can I do to make sure that I'm not removing controls, you know, that are there for a reason? Okay, so just be aware of that ongoing assessment of your part of the internal control responsibilities. Okay, so we teach our audit staff about internal controls all the time. That, you know, they learn about it in school, and then when they get into our office, you know, we start iterating what they've learned. And what we tell them to go into every office, every audit, and look for are these 5 key, we call them key controls, key areas of internal controls. It's sort of the backbone of any internal control system. And so I'm going to briefly go through them here. You can get more information if you'll just Google, I mean, seriously, you can just Google key internal controls and you'll find these control areas, but you can find more information if you need to, and I'll give you some resources later. But in the gist of it, segregating duties, this is one of those key controls that you really can't do without. And what this means is making sure that one person doesn't have complete control over a transaction cycle. It means one person shouldn't have the ability to make a serious error and then it never be found, or commit fraud and then cover it up. Okay, an example of this is that someone could take cash out of the deposit and then fix the books so that the deposit balances. Okay. Another example is a person that can order supplies, pay for the supplies, and then take the supplies home to use in a personal business. In both cases, the person is able to take the asset and then cover up the activity. That is a lack of segregation of duties. And if you're new to audits, that phrase might not start a fire in you yet. But what we find is officials get kind of upset with us because they'll start hearing lack of segregation of duties over and over and over and over. And they get, you know, a little upset, like, well, I can't do it. I can't segregate duties. But what they don't always understand is that this is so critical. It's such a critical internal control that we are not allowed as auditors to not tell you that you have this risk. If we see the risk in the office, auditing standards tell us we have to tell you about it. Okay, so if you're in an office where you have duties concentrated in one or just a few people and they're not sufficiently segregated, we're going to tell you that that's a risk that you have. And we're going to try to help you with some recommendations for how you can maybe pull those duties apart or assign them to different people or put other controls in place to try to help. But that's what this key control is. Concentrating responsibility and control too much in one person. The second one is securing assets. That's as simple as it sounds. Lock things up that are valuable. Cash in a safe, restricting access to vehicles, to equipment, and anything else of value. The third one is assigning or delegating or controlling access. And this is access to like things on site as well as computer access. And so this just means limiting access in people's jobs to only what they need. So if you've got somebody working in occupational tax, for example, they don't need access to the payroll system. You're going to limit their access to what they need for their job duties. That's restricting and controlling access. Also, it would be like limiting the ability to do a void or do an override to supervisors. Everybody in the office does not need the ability to do a void or an override. Might make things easier if everybody can, but that's not a control. The control is limiting that ability to only the people who need to be able to do it. The fourth control or fourth key area of control is documentation. And that just means maintaining sufficient supporting documentation for every transaction that happens. All the money that comes in, all the money that goes out, everything needs sufficient documentation to support it. These are going to be invoices and receipts and statements and paperwork to support voids and refunds and anything. I mean, basically, if you get a piece of paper that supports something, it's in your best interest to hang on to it for a while at least. If it's an unusual transaction, chances are your auditor is going to look at it and say, what happened here? Can you tell me about it? If you keep that documentation, that's going to go a long way in help explaining, what happened and why it happened the way it did. And then oversight and review. So providing adequate oversight for each process in your office. It doesn't have to be you. You don't have to go around and oversee every single area. You can cross-train other people, you can delegate to supervisors, but every area should have some sort of oversight and review. Everybody benefits from review. Everybody makes mistakes, and they're not always going to catch their own mistakes, and that's where the review and the oversight comes in. So just making sure that every significant area of the office has some sort of oversight and review in place. And then as we go through some specific controls, I'm going to talk a little bit more about these as they come up. But the next thing we're going to go through here are the two big broad categories of controls. Controls can be broken up into two, sort of big picture pieces, and they're preventive and detective controls. Preventive controls govern what happens before a transaction takes place, like requiring approvals for purchases or using a purchase order system, segregating duties so that one person doesn't have all total control, and then, putting locks on assets. Detective controls work after the transaction has taken place. And so these are going to be like bank reconciliations. These are happening at the end of the month. Even daily reconciliations are happening at the end of the day after the transaction has taken place. These are also reviews, having a second person review someone's daily work. And then like transaction logs or event notifications, those kinds of things are also considered to be detective controls. They can, an event log can show you who processed a void that day, that sort of thing. So those are detective. Now, a good internal control system is going to have a mix of both preventive and detective controls. We don't recommend one without the other. We don't say, oh, put all preventive controls in place and you're golden. Because they both play an important part of an internal control system. I think preventive controls work harder for you. And then with detective controls, they're easier on you to implement, but then you have to work harder to do them. I don't know if that makes a whole lot of sense yet, but we'll look at some examples, and I think you'll be able to see what I'm talking about that might help you decide which controls you want in which areas. So it's going to be a few slides from now, but what I'm going to do is go into some of the significant types of fraud that can happen, and then the preventive and the detective controls that can help either prevent or detect those frauds. But that's a couple of slides from now. The next thing I want to talk about, though, is the fraud triangle. Again, we typically give these trainings to an audience that has had some training, and so they've typically had some fraud training as well. And so what we find is that this fraud triangle pops up in every single fraud training, like across the nation. It's one of those theories, a long proven theory that works. And so it's typically worked into every single fraud training. So you're just going to get this very small introduction to fraud and the fraud triangle. Come back to more of our trainings or go to your association meetings where we do trainings, and you'll get a lot more in-depth information about the fraud triangle. But for today, I just have this one slide on it. So if you're interested, pay attention right here. But the long proven theory about fraud is that in order for any fraud or theft to be committed, you got to have all three elements for it to happen, all three sides of the triangle, if you will. The person needs to have a motive or an incentive to commit the fraud. And what we typically find is some sort of like gambling habit or a drug habit. They're living beyond their means, or they maybe just have a desire to have more than what more than what they can afford, more than what they have. And so that's an incentive or a motive for them to commit fraud, right? They also must have the ability to rationalize that behavior. They might think, well, I don't get paid enough. I haven't had a raise in a long time. They owe it to me. I'm owed more than what I'm getting. So they have to be able to rationalize. Sometimes the rationalization is, I'll pay it back. As soon as I use it to pay off this gambling debt, I'll win more money and I will pay it all back, and then we'll be even and nobody will get hurt, right? So they have to have a motive, and they have to be able to rationalize. And then the last thing that they have to have is the opportunity to commit fraud. And what we tell everybody that we give this training to is you only have control over that last piece. You can only control the opportunity. You cannot talk people out of their motive. You can't talk them out of their rationalization. You don't even know about it. It's happening in here. But what you can do is remove the opportunity. And you do that with your preventive controls. You put those controls in place. The opportunity is missing. They can't commit the fraud. That's the thought. And this stands all across the country, all across the world. Any type of fraud that's committed, you really have to have these three elements. So when you put these preventive controls in place, you have to kind of think about when we can't 100% prevent every single thing from ever happening. We have to try to find that balance. But you can drastically reduce the risk of fraud in your office if you put some good preventive controls in place. So again, this is all I'm really going to be able to talk about fraud in this general sense today. We have lots of good fraud trainings that we do where we give you a little bit more statistics about who's most likely to commit fraud, what positions people hold that are most likely to commit fraud. So if you have an interest in that sort of thing, keep an eye out for the trainings that we do at your associations. Okay, getting back to internal controls. I wanted to mention fraud there because it's just such a big part of the point of having a good internal control system is to help prevent those frauds from happening. So when I go, to trainings, and back when I was auditing, when I was in the field, I'd write recommendations and audit reports and say, okay, here's how you need to improve your internal controls. And then in return, the officials would say to me, well, I'd love to have stronger internal controls. I really would, but I can't afford it. I can't hire more people. I can't buy a better computer system. I can't afford the time or the effort to put in to strengthen my internal control system. So when I was putting this training together, I tried to think about things that don't cost anything or that cost very little to implement. And so what I tried to find were 3 or 4 really strong internal controls that you could put in place immediately. You can go back to your office, put them in place right now, and instantly, you can start shoring up a weak internal control system. Now, the disclaimer here is that these internal controls alone aren't going to fix a whole system if you've got systemic problems, but they can be a good starting point. So, try to take them with that thought that they're just a starting point. So on the next few slides, I'm going to talk about management tone, having written policies and procedures, doing surprise cash counts, and then listening to employee tips. So for management tone, we also call this tone at the top. This is kind of a foundation control. It's one of those underpinning kind of controls that sets up an entire control structure. Tone at the top is the theory that ethics and ethical behavior starts at the top, trickles down through management, all the way down to the staff level, to the rest of the employees. You know, a good management tone lets everybody in the organization know that management has a commitment to honesty and integrity and ethical behavior. It's also thought of as leading by example. Another proven theory is that if management's ethical tone is poor, you know, management has a poor ethical tone, and they'll see this, employees will see this in management's behavior. If they're skirting controls or they're doing things that ethically are on the line, that trickles down as well, and employees aren't always motivated to act in an ethical manner. And that's been proven if you look at Enron and some of those bigger organizations that were brought down by horrible management tone. There were frauds at the lower level as well, because those employees saw management acting unethically and then also decided that unethical behavior was okay. So management tone matters. It really does. And so a study was done, I think, what does that say, 2005, that found that employees that see management embodying these four items here on the screen or on the slide were more likely to believe management's commitment to ethics. And so when management informs employees, so communicating with employees, openly talking to them about ethics and ethical behavior, actually walking the walk and not just talking the talk, you know, actually living an ethical lifestyle and, you know, promoting ethics in the workplace. And then keeping promises. You know, if management makes promises to employees and then breaks those promises, you know, that immediately sets them up to think, well, management's not ethical because they're going to tell us things and then do other things. So if you can embody these four, they seem simple, these four criteria here, employees will start to believe you. They'll believe that you have a commitment to ethics, and then that commitment strengthens the entire internal control system. You know, it does trickle down. Tone at the top is an actual proven theory, and it does work. It doesn't cost anything. It just means you have to go in there and live the life. Do what you say you're going to do. Written policies and procedures. Another really good internal control is to have clearly written policies and procedures. These should let employees know your expectations for them, for behavior, for guidance, for job duties. This alleviates that word of mouth. I don't know how many times I've been in an entity and they said, well, I do this because this is how the person trained me to do it. I don't know why we do it. Word of mouth is unreliable, and it doesn't really have a lot of credence, you know, when nobody can really say why you're doing something. Having clear policies and procedures are what will help your employees understand what they're supposed to be doing. If you write into your policies and procedures that you have a commitment to fraud prevention and error prevention, you know, write it into the system that you expect the controls to be followed and not subverted, you know, get that right into the procedures, then employees will understand that they're expected to follow the internal control system and not try to go around them. Job duties that are written really clearly to segregate duties are helpful, because over time, sometimes when people leave or offices maybe get shrunken, you know, with staff shrinking and that sort of thing, job duties will get concentrated into certain people. And then that's where we start to see problems with one person having too much control. Clearly written job descriptions can keep that from happening, or it can give you a place to go back to. If you find that that's happened and you look at one person's position and they're doing way too much in one area, you can pull out those job descriptions and say, hang on, this person is really not supposed to be doing this and this and this. it gives you a place to pull those duties back apart and assign those to different people. But you got to have some clearly written job descriptions to be able to do that. Homogenizing those duties and having that just sort of happen naturally, it's one of those risk factors that we see that dramatically increases fraud risk when we see that start to happen. So just make sure that you're not allowing that to happen. And one good way is to have really good, well-written job descriptions. And then another sort of self-serving reason for you to have a clearly written policy and procedures for your auditors. We need to see them. We need to know what your policies and procedures are. We need to know what you're holding your staff to, what you expect from them. And it's hard to see sometimes when we go in. So having that clearly written set of procedures, can make a big difference. Now, I don't think I've seen a handwritten policy and procedure like the one on the screen here, but I've seen something really close. And I know Farah's on here and she has too, because she and I were in the field together. Maybe not handwritten, but typewritten, on a really old typewriter. I was in the field, not in the 80s and 90s. I was in the field well after 2000. But I would see policies and procedures still in use that had been done on a typewriter in the 80s. Okay, those are probably outdated by now. They've been this yellow. I definitely saw some that were this yellow and coffee stained and that sort of thing. So if you look at your policies and procedures and you're seeing a document that looks like it could go in a museum, really consider updating those policies and procedures. Get them into this century. It'll do your staff worlds of good to have an updated set of procedures that they're working from. It'll help your auditors understand what you're doing, and it'll show your commitment to the public that you're on top of things and that you're, hoping to bring your county up to date on everything. So take a look at your policies and procedures when you go back to your office. I'd be interested to see if you all find anything that looks like this. All right. So like I said earlier, what I'm going to do is I've got one more. No, I've got two more zero cost internal controls, and then we're going to go through some areas to look at the controls that you can put in place. So for surprise cash counts, this is one of the my favorite internal controls that you can do for no money. You can go back to your office tomorrow, or you're in your office. I know you are. We're pretending you're in the conference with us, but you can go into your office tomorrow and do a surprise cash count and just get that started. This control pulls double duty. It's preventive and it's detective. There aren't very many controls that do that, so this is a really good one. Preventatively, studies have shown that when employees know that they might have a surprise cash count or a random cash count, they're less likely to do things that are risky, that might make their drawer be off or might make them be out of balance at the end of the day. They'll pay more attention to detail, and then they're less likely to think that taking some cash would be okay. Now, the preventive part is employees knowing that you may do surprise cash counts. That does not mean like announcing like, okay, today at the end of the day, we're going to have a surprise cash count at 3 o'clock. You don't want to announce the surprise cash count. You don't want them to know when it's going to happen. You just want them to know that it's a control that you intend to put in place. And you don't have to, come down on them like, I suspect everybody of fraud, so I'm doing surprise cash outs. What you would say is, we're trying to fix our internal control system. And one thing the auditors, I always say blame the auditors if you want. One thing the auditors have recommended that we do is surprise cash count. So we're going to just start doing it randomly. You won't know when it happens. It'll just happen. And there it is. So letting them know that it's a possibility is the preventive part of it. Okay. And then follow through. Don't do it every Friday at 3. Do it irregularly, different times a day, different days of the week. But if you just do it a few times, you'll start to get people to understand that this is just one of those controls that you have in place and it just exists, that it's not personal or anything. But it is working as a preventive control at that point. As a detective control, you can uncover some different larceny schemes just by randomly counting cash, because what happens is if they take cash out, before the end of the day and haven't had time to fix the books side of things, then they're going to be out of balance. Cash is not going to equal the books. So, that will be able to detect that scheme pretty quickly if they haven't run a void or done whatever they need to do to adjust the books to agree to the cash. So, consider implementing this. It's such a simple control to put in place, and I'd be interested to see if you all find any benefit from that. Okay, before I flip to the next slide, Jonathan, you have my polling question up. You're so good. Jonathan's put a polling question up. What do you think, how do you think the majority of thefts and fraud are discovered? I'm curious what you think. There's no right or wrong answer here. You just let me know what you think. All right. 20 or so responses in. It looks like most people said tips. All right. It sounds like this isn't a surprise to you. And so that's good. That's really good that you already know this. Employee tips are the most common way fraud is discovered, far beyond any other method of fraud discovery, including internal and external audits. So this makes your employees a potential fraud detection control for you. But for it to actually work, employees need to know how to get those tips to you, how to report suspicious behavior to you. And they should feel like they can make a report to you without the risk of retribution. So it's best practice to not have an employee report suspected fraud within their department or to their own department head. And for a couple of reasons, that employee might fear some sort of retribution or some sort of blowback if they think their department head won't investigate or won't take the tip seriously. And the department head might be involved, in the fraud. So the employee may be hesitant to report, for that reason. And I know I've got a telephone on this slide here, but statistically, what's been found in recent studies is that employees are more likely to email or do a web-based reporting than to make a phone call. But phone calls are still, valid way for an employee to get a tip to you. They're just more likely to email or to get that information to you in a little bit more of an anonymous way. So decide how you want employees to be able to report suspicious behavior to you. Clearly, it's an important way to get information. So you want to be thinking, if your government that you're involved with, whether it's a county government or a sheriff's office or a clerk's office, if you don't already have a way for employees to report suspicious behavior, think about how you want them to handle that. And it can be as simple as setting up an email address and just letting everybody know about it. Here's the email address. If you have something that you're concerned about, send it to this email address and we'll take a look at it. Tips can also come in from the public. Think about whether or not your county has a way for those to come in. Do you have a button on your website? Do you have an email address set up? Do you have a way for the public to be able to get that information to the right person? Again, them calling the road foreman about a concern they have about the road department might not be the best plan, so think about where you want tips directed to and how you want those handled. And then just make sure people know about it internally and externally, make everybody aware of how that happens. On our website, if you go there, you're going to see a big button, like a big flashy button that allows people to both report and upload documentation to us to let us know about things. And people do it all the time. We get tons of tips. So it is a really, really valuable control. And it, if it's a matter of an email address or putting something on your website, it's not going to cost you anything. So consider doing this low cost or no cost control. All right, so these are kind of big picture problems that we see when we find internal control problems. These are like the biggest issues that we find when there's trouble in an internal control structure, the overall control environment. The first one is too much trust in a key employee. And it's easy to start leaning on a high achiever, a fast worker, somebody who's taking on extra work, somebody who won't take a vacation. Just be aware that doing this increases the fraud risks because it's giving that person a lot of control in one area, and it may be taking your eyes off of them because their competence level is giving you this false sense of, well, I can let that area go, put my focus over here. Taking that focus off of them, takes away that management oversight that they really need to have. So just be careful about that. You want to make sure that everybody understands the procedures for authorizing transactions. Sometimes going around a control is just easier, and that's what people want to do. But make sure that everyone understands that they have to go through the proper authorizations when they want transactions to happen. If you find yourself going around a control over and over and over again, or allowing people to go around, that control is not working for you. Consider it needs to be replaced with a different control. Not segregating duties, between authorizing and custody. This is what we were talking about earlier. Taking cash, fixing the books. That's authorizing and custody. If they can take it and then they can fix it and cover it up, then you haven't segregated the duties between those. You've allowed one person to be able to commit the fraud, conceal it, or commit the error and it go undetected. And no independent review of their work. So reviews are good for everybody. They catch mistakes. Mistakes can snowball. So don't think of reviews as a negative thing. Reviews are important. And then inadequate attention to detail. So it can be difficult to keep an eye on everything. Your attention's divided in a lot of different ways. So try to make sure that the areas that need more attention and, make sure that it gets that attention. Now we're going to look at some of the most common types of employee frauds and then the controls that you can put into place to prevent and detect them. So I've got 6 different types of fraud here. So what I've got is 2 slides on each, where the first one tells you a little bit about what the fraud is, and then the second slide will tell you some preventive and detective controls that you can put in place for to prevent or detect that particular type of fraud. So the first one is cash-based. So it's skimming and larceny. So skimming is taking cash before it hits the books. Cash larceny is taking cash after it's been booked. Simple as that. Skimming is like telling taxpayers, somebody at a desk telling taxpayers, hey, there's an extra $5 charge on your bill. If the taxpayer believes it and pays it, taking that $5 before it gets anywhere, booking the tax payment, they've taken the cash before it hits the books. Larceny would be taking in the money and then later taking the cash out of the drawer and then fixing the book somehow with a void or a refund or in some way to make sure that the book's in bank balance. So that's the difference in those. You can prevent skimming by trying to reduce the cash transactions that are happening. I know some offices went cashless during the pandemic. I don't know if that helped with skimming. I can imagine it probably did. You can make sure that receipts are issued so that people get a receipt that says, here's how much money you gave me and here's how much I posted to your account, that sort of thing. Control who's able to do a void so that people aren't able to, make adjustments, make daily deposits, get that cash out of there. If it's not on site, it can't be taken. Rotate duties so that one person isn't always handling the cash. There really aren't good detective controls for skimming because it's taking cash before it even gets in your system. So your focus really on skimming needs to be preventing it from happening in the first place. For larceny, this would be where segregation of duties would really help, not allowing the person that receives cash to also be able to alter the books, not allowing that person to be able to process a void or do a refund unless there's an approval. And then those surprise cash counts would really help with that as well. For detection, having another person reconcile the cash drawer the end of the day. That can help detect larceny if a different person is going to be counting the drawer, comparing it to the books. The second type of employee fraud is misuse of assets or misappropriation of assets. And this can be misusing county property or taking equipment home or using county property like in a side business if they have that sort of thing. So what you can do to prevent it is to have clear policies and procedures, saying that personal use of county property is not okay. Set an example, don't do it yourself and don't allow people to do it. And then make sure you have a plan in place to secure all of the assets. For detective controls, be alert and then have your hotline available. Lots of times employees know what other employees are doing. So if someone comes to you and says, I think this person's doing this, pay attention because it's very possible that that is happening. For purchase fraud or purchase order fraud, in a really good purchase order system, that's a good preventive control all by itself if it's being used consistently. If it's not being used or some departments use it and other departments don't, or lots of exceptions are granted, then you get what you pay for, right? So it's not as good as it could be if it was being used consistently across all the departments. So the things like this that can happen, a person can collude with suppliers, they can increase pricing. An employee can create like a shell company and do business with that company. They can order extra supplies or unnecessary supplies. Again, if your purchase order system's working, it will stop a lot of this. But if you're not using it very well, then these things can get through. People can make fake invoices. We see it all the time. Submit them for payment, and then they'll pay them because they're also the person that pays the bills. And then externally, sometimes you have suppliers that will take advantage of you. They'll give you a PO and agree to a price, but then when it comes around to billing, they'll bill you at a different price, hoping that you won't notice. So, make sure that somebody's paying attention to that sort of thing. So what you can do to prevent that is to have good policies and procedures in place and then make sure everybody understands that they need to follow them. Use your PO system the way it was intended. Segregate duties to make sure that no one person can order and pay, and be able to subvert that. And then review purchases really carefully and limit the ability to purchase to certain people. Everybody in the office does not need the ability to make purchases. For detective, keep control of supplies, have some sort of an inventory going so that you'll notice when somebody has way over ordered supplies or when supplies are being depleted too fast. And then again, have a hotline or a tip line, for employees or for suppliers to be able to report to you if they think something is wrong. For credit cards, the typical credit card schemes involve like personal purchases or charging travel or extra travel, for family members, that sort of thing. And so what you want to do for credit cards, have a written policy to make sure everybody understands how credit cards are supposed to be used. Make sure that you get a detailed receipt for everything that's purchased with a credit card, and then limit access only to those people who need to use the card. Credit cards really shouldn't be your default payment system. It can be like a backup plan for when regular payments aren't available. You're buying something online and the normal cut a check, mail the check payment process isn't acceptable. You can use credit card, but make sure that it's not like your go-to way, because credit cards, they introduce a whole new level of frauds because if you're not paying close attention to the statements and to what's being purchased, lots of things can go under the radar. And we do see a lot of this. We see a lot of personal purchases on government credit cards. So for detective controls, someone should always be matching statements and receipts. You should have a detailed receipt for everything that happens on that credit card statement. Preferably, that's not the person who made the purchases. That you've got somebody other than the person making those purchases matching so that they can see if those items being purchased are for use in your office or if they're more personal in nature, so that's one of those segregation of duties that will really help there. And then just making sure that when items are purchased, that someone does see them come in, that you order some iPads, for, I don't know, for whatever you've decided you need them for, that those are actually coming into the office and being used there and not going home with someone. Payroll fraud is a little trickier because most people should not have access to the payroll system. So payroll fraud typically involves people who have that sort of universal access or access to the payroll system, and it usually involves ghost employees, altering timesheets or changing pay rates. Ghost employees can be real people or fictitious people who don't actually work for you. They can be real people with a real Social Security number. They just happen to not be an employee. They'll be put onto the payroll by a person, cut some paychecks, and then taken off the payroll before W-2s are cut at the end of the year. This is usually done by somebody with access to the payroll system. So it's kind of an insular kind of fraud that happens, but it does happen. Now, timesheet alterations can happen, where people add time to their timesheet and they know their supervisor's not really looking at it. So you got time theft. Those things can happen at different levels, but payroll fraud is pretty unique. So what you do is make sure that you have strong policies and procedures for payroll. Make sure that people know that they're expected to record their time accurately on their timesheet and that supervisors are required to look at those timesheets and make sure that they are accurate. Segregate duties. The person who prepares payroll should not also be able to add people to the payroll system, change pay rates, change benefits. You need to have those duties segregated between different people, or at least levels of review in there, so that there's two sets of eyes on a new employee being added to the system or a pay rate change. And then just really severely limiting access to payroll will be a big help there. And then for detective, make sure you're looking at payroll reports, look for employee names once you become familiar with all your employees, and make sure that you are seeing the employees that are on the list that are getting paychecks. Make sure that they actually exist and that they actually are employees, and then watch for changes. Dramatic increases in someone's pay without a reason would be a reason to investigate. And then corruption is the final category of fraud scheme. Corruption has lots of different faces. It can be kickbacks, where an employee will orchestrate like a favorable deal between the government and a bidder or a vendor or supplier, and then get a kickback. Limiting bids is a type of corruption. Providing building permits or waiving fees or taxes in return for favors or payments, personal payments. Those would be forms of corruption as well. To prevent corruption, it's good to have a strong ethics policy and make sure everybody knows what it is and that you have a commitment. Set the tone at the top that fraud and corruption is not going to be tolerated and will be punished. And then segregate duties to try to prevent someone from being able to orchestrate deals like this. And then for detective, pay attention. Lots of times corruption is known. Lots of times people in the community know about corruption and they'll tell us about it. So make sure you're listening if people are talking about corruption. So special considerations about offsite locations. If you have an office that has more than one location, just be aware that offsite location might not be getting the attention that the main office is getting. So think about controls there as well. There are lots of different types of branch offices and things. Just make sure that you're giving them a sufficient amount of attention so that they're not going under the radar. We consider offsite locations to be of higher risk just because of this. Naturally, they get less focus from management. So what do you do now? Now that you know the very bare bones basics about internal controls, you're going to want to do some sort of risk assessment. You're going to want to go back to your office and think, okay, what are my risky areas? Where do I need to shore things up? would I be able to answer these questions? Would I know if someone wrote a check to themselves? Would I know if someone's misusing property? What if we're paying fake suppliers? Would I know if this is happening? Start thinking about these things and think about where your risks are, and then just start thinking about what you can do in those areas to shore up your internal control system and make it a little stronger. The consequence, I know I'm kind of going a little quicker here at the end, but I want to get through all these slides. The consequences can be pretty dire if you don't have good internal controls in place. Remember that last question on my objective slide was, what happens if I don't have internal controls or if I don't want to put them in place? As far as federal money, the federal guidelines say you have to have internal controls. We have to look for them, and we have to report if you don't have them. So that can impact federal money significantly. They can take money back. They can cut you off and decide not to give you any more. They can put you on these deficiency plans. So as far as federal authorities go, controls are non-negotiable. You have to have a strong internal control system in place. For your audit, you can have findings in your audit called material weaknesses and significant deficiencies. If your internal control structure is not in good shape, we're required by our auditing standards to report that. We're required to tell the public about deficiencies in your control system. So it is in your best interest to get it in place and document it and make sure that your auditor understands what you've done to improve internal controls if you've had comments, if the office has had audit comments in the past. And then beyond that, there can be long-standing consequences. If you have a theft or a fraud due to weak internal controls, you could have law enforcement investigations. You could have your reputation suffer, both your government and your personal reputation, and staff morale will be damaged. I have not seen an office where I've seen a fraud where staff morale wasn't just completely destroyed. It just kills everybody when something like this happens. So it really is in your best interest to make sure that you're doing everything you can to shore up your internal control system. And then resources. So I wanted to end this section with some resources where you can get some more help. The AICPA website has a toolkit for governments, and specifically for smaller governments. If you want to go there, you're going to get this slide, so you'll be able to get this website once we send the slides out. And then the federal government uses what's called the Green Book for internal controls, and it's a comprehensive system of controls that the federal government's required to follow. Lots of good advice in there that can be adapted for smaller governments as well. And I think I've ended up exactly on time, Jonathan. So I don't think there's time for questions, but they can send me questions and I can talk to them through email.
All right. Thank you very much, Liz.